Have you ever wondered which ETF between VUG and VGT would give you better returns? Today we're going to explore that very question. First, let's get to know these two players. On one side, we have VUG, the Vanguard Growth ETF, which offers exposure to large-cap growth stocks in the US market. On the other, we have VGT, the Vanguard Information Technology ETF, focusing on stocks from the technology sector. ETFs, or exchange-traded funds, are investment funds traded on stock exchanges, much like individual stocks. They offer the benefits of diversification, lower costs, and flexibility in trading. Both VUG and VGT are products of Vanguard, a globally recognized investment management company known for its low-cost and high-quality funds. So we're dealing with two strong contenders here. Now let's dive into the performance of both ETFs to see which one could potentially give you better returns. When it comes to performance, the numbers speak for themselves. Let's take a closer look at the Vanguard Information Technology ETF, also known as VGT, and the Vanguard Growth ETF, or VUG, to see how they stack up. Imagine for a moment that you had invested $10,000 in each of these ETFs. Over time, the Information Technology ETF would have grown to a whopping $123,987. The Growth ETF, on the other hand, would have grown to $79,116. That's a significant difference, and it's clear to see that the Information Technology ETF outshone the Growth ETF in terms of final balance. But what about growth rates? This is where the compound annual growth rate, or KGR, comes into play. It's a useful measure of the mean annual growth rate of an investment over a specified time period. The Information Technology ETF boasted a CAGR of 13.91%, outpacing the Growth ETF, which had a CAGR of 11.29%. This suggests that the Information Technology ETF had a better growth rate over the analyzed period. Now, here's something to ponder. If you had dollar-cost averaged your investment in the Information Technology ETF, adding $1,000 every month, your investment would have ballooned to a staggering $1,891,446. That's the power of consistent investing and the magic of compounding. However, it's not all roses. The Information Technology ETF exhibited higher volatility, as indicated by a higher standard deviation of 19.22% compared to 16.70% for the Growth ETF. But as they say, with higher risk comes higher reward. While the Information Technology ETF outperformed in terms of final balance and growth rate, it's important to consider the risk factor. After all, investing isn't just about chasing returns. It's about understanding and managing risk to achieve your financial goals. As with any investment, risk is a vital factor to consider. Let's delve into the risk metrics of both the Vanguard Information Technology ETF and the Vanguard Growth ETF. Firstly, we look at the standard deviation, a measure of volatility. The Information Technology ETF had a higher standard deviation of 19.22% compared to 16.70% for the Growth ETF. This means that the Information Technology ETF experienced larger price swings, indicating a higher level of risk. However, risk doesn't only come in the form of standard deviation. We also have to consider drawdowns, or the peak-to-trough decline during a specific record period of an investment. Both portfolios experienced significant drawdowns, with the Information Technology ETF at a 50.58% drawdown and the Growth ETF at a 47.18% drawdown. These figures remind us that even high-performing ETFs can experience substantial declines. To evaluate the return of an investment compared to its risk, we use the Sharpe ratio. The Sharpe ratio for the Information Technology ETF at 0.7 is higher than that of the Growth ETF, which is 0.64. This suggests that the Information Technology ETF provided better risk-adjusted returns. The Sortino ratio is another metric used to measure the risk-adjusted return, but it focuses on downside risk. The Sortino ratio for the Information Technology ETF at 1.10 is higher than that of the Growth ETF, which is 0.97, suggesting that the Information Technology ETF also has better risk-adjusted returns for downside risk. So while the Information Technology ETF showed a higher level of volatility, it also provided superior risk-adjusted returns. Each investor must weigh these factors based on their risk tolerance and investment goals. While the Information Technology ETF showed higher volatility, it also provided better risk-adjusted returns. But how do these ETFs correlate with the market? Market correlation can significantly impact your investment returns. Both the Vanguard Information Technology ETF, or VGT, and the Vanguard Growth ETF, or VUG, exhibit a strong positive correlation with the market. This means they tend to move in the same direction as the market. VGT has a correlation of 0.91, while VUG is slightly more correlated at 0.96. Now let's talk about expense ratios. The expense ratio is the annual fee that all funds or ETFs charge their shareholders. It's important to consider this when choosing between different investment options. VUG has an expense ratio of 0.04%, while VGT's is slightly higher at 0.1%. While VGT has a slightly higher expense ratio, it also boasts a superior growth rate. If you were to dollar cost average VGT, adding $1,000 per month, you would have had $1,891,446. Both ETFs have a high correlation with the market, and while the Information Technology ETF has a slightly higher expense ratio, it also has a superior growth rate and better risk-adjusted returns. So, which ETF between VUG and VGT would give you better returns? This question has been our guide throughout this discussion. Looking back at our analysis, the Information Technology ETF had a higher compound annual growth rate of 13.91% compared to the growth ETF's 11.29%. This indicates a stronger growth rate for the Information Technology ETF over the period we analyzed. In terms of risk metrics, the Information Technology ETF showed higher volatility, but also better risk-adjusted returns as indicated by its higher Sharpe and Sortino ratios. Although the Information Technology ETF has a slightly higher expense ratio of 0.1% compared to the growth ETF's 0.04%, the substantial returns it could have brought you, especially if you'd been dollar cost averaging, might have been worth this small trade-off. While past performance is not indicative of future results, the data suggests that the Information Technology ETF could potentially offer better returns. As always, make sure to do your own research and consult with a financial advisor before making any investment decisions.